Hello traders everywhere, Adam Hewison here, president of INO.com and co-founder of MarketClub. Welcome to Traders Whiteboard. Today's lesson may be the most important one I'm going to share with you in the Whiteboard series. The lesson is not about how to make money. It is something much more important, and that is how to preserve your trading capital. What I'm talking about is how to use stops and money management. Most investors think stops are for someone else and ignore them. Stops and money management are probably the two most important elements to successful trading. We will be discussing three types of stops today. They are 1. A dollar stop, 2. A percentage stop, and 3. A chart stop. Each of these stop strategies have their advantages and disadvantages, and we will be discussing them one by one. Let's begin with a dollar stop. Before we get started, let me share with you an important trading tip. Avoid trading in markets that have very little volume. Okay, let's get started. Let's talk about a dollar stop. A dollar stop works like this. You buy a stock, let's say at 20, and you want to risk $500 on the trade. If you buy 100 shares and the market goes down $5 from your buy point at 20, then you'll be stopped out. If you buy 200 shares, you have a $2.50 risk, which equates to a $500 loss. If you buy 1,000 shares, you'll be risking 50 cents. So clearly managing your money with this stop allows you to judge how many shares you want to buy. One clear advantage with this approach is that no one knows where your stops are, because no one knows what your risk tolerance level is. One of the disadvantages of using a dollar stop is in very volatile markets. You could be stopped out very quickly if you have your stops too close. To avoid this problem, you should buy fewer shares, which would widen your stop in a volatile market. Okay, let's move on to percentage stops. A percentage stop is exactly what its name implies. That is, if a market pulls back a certain predetermined percentage amount from the high, you would get stopped out. That percentage stop could be anywhere from 5 to 10%. Here's how it would work. Assuming you had purchased a stock, you would change your percentage stops based on a pullback from a previous high. For example, if the rally high for a stock was 20 and you're talking about a 10% risk, then your stop will be placed at 18. If the market pulled back to 18, you'll be stopped out. There are no disadvantages with this strategy as you are seriously managing your risk profile. Next, let's talk about a chart stop. A chart stop is when you place a stop below a recent reaction low on whatever you are trading. One of the big disadvantages of this is that everyone knows where the stops are, and sometimes in a thin market, professional traders will push the market down to hit the stops. A chart stop in a big liquid market is very powerful way to protect your capital, as it takes a lot of energy to push a market below a significant chart point. Now here's the key. Stops preserve capital, and they're very important. Using stops to preserve capital will put you way ahead of most traders. Ignore them and you'll regret it. Use them and you will be successful in the markets.